So, tonight we thought we'd do something a little bit different. Everything you always wanted to know or ask about Medicare, you know, you were afraid to ask because it is pretty scary. We're gonna, Fran got a few questions from people. So we're gonna take care of those questions, and then if we have a little extra time, we'll see how it goes, okay? So I'm gonna go through the basics. First of all, we're gonna look at the agenda. What is Medicare, real quick, just the basics. When must I enroll in Medicare to avoid penalties? That's a biggie that I get from people. Irma, who's she? Who gets my money? And then Q&A. Okay, so hopefully these topics will help clarify. How many of you are not on Medicare yet? Okay, so some of this is for you right off the bat. Okay, and those, that means the rest of you pretty much are. Okay, great. So Medicare is health insurance, of course, for those who are 65 or over. If you're under 65 with certain disabilities, and or if you have end-stage renal disease. And there's 4 components. So, okay, you Medicare people, what's A? Hospitals and skilled nursing facilities, right? What's B? Medical, everything outside the hospital, ambulatory centers, x-rays, lab work, anything outside the hospital is B, okay? Then we just skip a second to D, because that's drugs. So that's easy, a standalone drug plan, because A and B does not cover drugs, so later on they added D to help, because that's what most people need is prescriptions, right? And then Part C is Medicare Advantage. Those are the plans you see advertised on TV all the time. And typically they're network plans. Under the umbrella of this network, you have your A, B, and D. So you have your hospital, your medical, and your drug plan under the umbrella of a Medicare Advantage plan, okay? Then the 5th component is supplemental insurance, or what we know as Medigap, because Medicare, of course, does not cover everything. It covers 80% of your costs after the deductible. So it's important that you have some other coverage besides Medicare alone, otherwise you really are exposed. You could have a lot of risk. So the Medigap plan is the 5th component. They're sold by private companies. It fills in all the gaps of what Medicare doesn't cover. They are standardized plans, so every plan is the same no matter who the underwriter is. The only difference between them typically is how much they cost. And the difference, that's the difference, is in the underwriting or your perception. Some people just, you know, love Aetna or love AARP or whatever it is. You know, they just have a good perception or feeling about a particular plan. Okay? Now, in terms of Medicare, there's only 2 paths you can go. A and B, get yourself a drug plan and get yourself a Medigap plan. Or a Medicare Advantage plan, which includes all 3. So what's the diff? The diff is choice. With these plans, you stay within a network. If it's an HMO, it's a stricter network. If it's a PPO, you have some in and out of network and maybe a larger network of doctors. That's your Advantage plan, but you must use their doctors, their hospitals, their x-rays, their lab work. So you have to be really careful if you're having work done in a Medicare Advantage plan that whoever you're going to for your services participates in that plan. Okay, very important. This side, you have choice. You can go to any doctor, use any facility or hospital that accepts Medicare assignment, meaning they accept what Medicare pays. All right, they don't balance bill you. They just, you know, they're willing to accept whatever Medicare pays. All right, so the big thing I always talk about, you know, for some people in their decision making, there are certain hospitals that don't accept Medicare Advantage plans, such as Sloan Kettering. Now, God forbid, I don't wish cancer on anybody, but if I got it, I'd like to know that I could go to Sloan Kettering if I wanted to, at least for a second opinion. And with those types of plans, they're not accepted. So, you know, it's something to think about when you're making these choices. And that's why I'm so grateful for Barron, because they let me talk to you before you get to the point where you might make a bad decision. you know, so I'm very grateful for that, and that helps me to help you. Okay, so that's the basics of Medicare. Now we're going to get into our questions. How many of you think when you turn 65, and if you don't join Medicare right away, you're going to get penalized? A few of you, right? Untrue. Different circumstances, okay? So, if you're an active employee and you work for a company with 20 or more employees, you can be on your company's employee plan until the day you leave that firm, and you do not need to join Medicare until you leave the firm. As long as you're an active employee with coverage, you're good. Now, sometimes people join Part A. Why? Well, they say it's free. It's not free. You paid for it your whole life. But it doesn't cost anything. And maybe if your plan's hospitalization isn't as good as you'd like it to be, and you had to go in the hospital, maybe Medicare would pick up some of those extra costs. So that's why some people join Part A at that time. No harm, no foul. You have it just in case. But if your employee plan has an HRA, a health reimbursement account in which you participate, it's not a good thing to join Medicare, because then that money becomes taxable. Okay, so one thing to keep in mind, whether you join Part A or not. It's the only thing that would keep me from doing it, is that health reimbursement account. Otherwise, no harm, no foul. It doesn't cost anything, and it might help you. That's an active employee with 20 or more employees. If your company is smaller and there's only like 1 to 19 employees, typically as an active employee, you must join Medicare Parts A and B when you turn 65. Because they're small employers, their insurance then is considered secondary. You know that whole idea of who pays first, who's on second, what's on third, you know, that whole coordination thing. If a company's smaller, then you need to enroll in Medicare Parts A and B, because that will become your primary coverage, and the active employee plan will be your secondary coverage. But it's always good to check with your HR, although unfortunately lots of times they don't know, but you can call me. But anyway, they're the ones, the rules of their plan will determine it, but typically that's how it works. Okay? So there's no penalty for being an active employee and staying on coverage. Okay, so when do you sign up? Your initial enrollment. It's 3 months before you turn 65, the month you turn 65, and month 4 through 7 when you're turning 65. Why you would wait that long, I have no idea, because you're going to be without coverage for a bunch of months. So my recommendation is always join when you're eligible. Make sure you have everything lined up. So the first date you retire and you don't have coverage, your Medicare kicks in and your supplemental plan kicks in, and you're good to go. Okay? If you're collecting Social Security, typically you automatically get your card. If you're not, you have to actively sign up through SSA.gov. That's a good way to sign up for it. This is where penalties happen. If you don't sign up when you could have signed up in that 7 months, well, then you can't sign up again until January of the following year for the insurance to become effective in July of that year. So you could be a whole year without coverage. And every year you don't have coverage when you could have had it, 10% penalty. So if you pay $135.50 for your Medicare, add 10% to that, and you'll be paying that the rest of your life. If you didn't join for 2 years when you could have, 20% penalty, 30% for 3 years, on and on, for the rest of your Medicare life. So it does behoove you to join when you can and have everything all set. Okay? Special enrollment. This is all to avoid penalties, okay? Because you had questions. If you turn 65 and you are an active employee, interestingly enough, you can join Medicare anytime you want. It's your choice. Why would you do something like that? Well, maybe the insurance at your company isn't that great. Maybe it costs a lot of money. So maybe you do better if you go outside and just join Medicare and get a supplemental plan. It might be less expensive than staying on your company's plan. And the coverage might be better. So it is something to consider if you are an active employee. Okay? It's a possibility. And then when you retire, if you have no retiree coverage, nothing coming from a company anywhere else, you're on your own, you have 8 months to join Medicare Part B. Why you'd want to wait, I have no idea, but you have 8 months, okay? Then you must join Medicare Part B or that clock starts ticking for the penalty. And then COBRA, very important, COBRA and retiree coverage is not considered active employee coverage. So again, to avoid penalties, you need to join when you can, as soon as possible. When your other coverage ends, you want to make sure you got your date set and you're ready to go. Some people, the companies, as part of a package, they'll say, well, we'll pay for your 18 months of COBRA coverage. Well, that's good for the first 8 months. But after that, it doesn't count. So you need to make sure you get into something. Okay? I know I'm throwing a lot at you quickly, but these are the areas where the penalty clock starts ticking. And then, of course, we have our typical annual enrollment, which again is from October 15th to December 7th, where you can switch your drug plans. If you're in a Medicare Advantage plan, you can switch those plans. If you're in a supplemental plan, there is no need to ever change. You just stay there, enjoy it, pay your bills every month, and don't worry about it. If you're in a Medicare Advantage plan, you might want to look at it. Do my doctors still participate? You know, are my drugs still on the formulary? There's a bit more work with them. And of course, the prescriptions plan, you know, it's a shell game. They move the parts every year. So you really have to look at your prescription plan to make sure it's still effective for you. IRMA. We had a couple questions about IRMA. What is IRMA? Well, some people with higher incomes may pay a higher Medicare Part B monthly amount. So, you know, you see the different ranges that are there. And they always look back 2 years. So if you're joining Medicare in 2019, they're going to look at your modified adjusted gross income for 2017, because that's the latest tax return that they have access to. They might not have 18 yet. Of course, when you first go into 2018, of course they don't have it. So they have to look back 2 years. So these are the ranges. So the biggest question comes up, well, what if, you know, I was in the third range as a couple, we were filing our taxes, and I made, you know, $220,000 a year, but now that I'm joining Medicare, my income is dropping like a rock, and do I have to keep paying? No, you don't. This is what happens typically. If you do nothing, when your 2020 tax return, when your 2018 tax return comes through, they look to see how much you made. And then they'll either drop it or raise it. Sometimes it could raise. Someone gets a buyout when they leave the company or something, so they get a raise in income. But if it drops and you go below that range into the next range, then they will adjust the amount and they will credit the account from when you started Medicare. So say I start Medicare in July of this year. In 2017, I made $220,000. Okay, I'm in range 3. That's the only record they have for me. But when they get my 2018, I'm still in range 3. So they keep charging me the high amount. Well, when they get to my actual 2019, when I dropped because I'm no longer working, they will adjust it and bring it down. And all the money I paid already into that, I'm going to be credited, because you're being charged based on when you come into Medicare. I joined in July. So July, that's where they're going to, once they get to 2019 and see what my actual earnings were and that they dropped, they'll give me all that money I prepaid back. They used to write a check, but now what they do is they credit your account and they just work off of it as you pay your Medicare. Now, why should the government have that money? Why shouldn't I have it to play with and go somewhere or buy gifts for my grandchildren or do whatever? Sure you can. There is a form, SSA-44, And you take that with you down to the Social Security with maybe your, you know your income's gonna drop, you have paperwork, you can show what your income's gonna be. Or maybe your 2018 return is much less than it was and you've dropped a range. You bring that and you talk to them about it and they'll change it immediately. Okay? So you don't have to let them be collecting your money all that time. Now, if for some reason it goes up, they're going to catch that too when the time comes. And then they'll charge you more and they'll charge you the backdated amount you didn't pay. So some people have actually looked into filing separately with their accountants, you know, to see if they work out better that way. If one is over 65 and say the spouse that's still working and making really good money. Now, eventually, no, so that would be a way maybe to look at, is it better to file separate returns? Yep. Yes.
Does that rule apply in like years 3, 4, and 5 after you're in Medicare? You can go back and give you retroactive credit. It's not just your initial year of Medicare, but say you're in now year 4 of Medicare.
Yes.
And your income drops in year 4. For that particular year, and 2 years later, they'll give you a credit back to the beginning of year 4.
Yeah, but they're going to give it as soon as they can when they know. The figure they look at is a 2-year look back. So as soon as they get that tax return for that 2-year look back, they're going to adjust your cost. Okay? Yes?
But if you're signing up now at a high income year, or wait till January to sign up, which would be a low income year.
If you're turning 65 in this year, you're past it. And so you're thinking of, and you're still working.
And about to leave.
And about to leave, I might wait till December 31st.
Okay, that's kind of what I was thinking about.
Because I've had people, I've compared them as active employees who have the ability to go on Medicare if they want, because they're 68 years old. And their income, they were in the top range, above $750 and above. So by the time they added the $460.50 for their Medicare Part B and the $71.40 or whatever it is for their drug plan, it pulled up their Medicare costs plus their supplemental plan plus their drug plan. So it wasn't worth it for them to switch. But I got a call the other day, now he wants to switch because he's so upset with the coverage he got during a knee replacement or something, that he wants to go on Medicare because he knows he'll get better coverage. So
Yeah, well, I was thinking actually just doing COBRA for the gap.
you could do COBRA for the gap if you want to get out of there.
Next year, which is a low income year, and then
Yes.
switch out of COBRA.
And you have 8 months to join Medicare Part B, as long as you have coverage. Yeah. But usually COBRA costs more than Medicare, unless your income is high. If you have a higher income, then, you know, if COBRA's $900 a month, by the time you pay around $500 for your Medicare Part B and your drug surcharges, and then, you know, $170 for your supplemental plan and $12 for your drug plan, they could match. That's why it's good to analyze that stuff. Yeah. Yeah, there's always things to think about. Okay, so that's IRMA. Have I answered the questions about IRMA that people wondered? Is it clear? So that SSA form, you just make an appointment with Social Security. If you overpaid, you'll get credit. If you underpaid, but it's really based on when you joined Medicare. So you weren't in Medicare 2 years ago when you were making a ton of money. So if you know that your income is really going down and you can provide some kind of proof or something that that's going to happen, bring it with you and see what they say. They're really quite open-minded. Yes?
So, but if you just want to wait till they do it automatically, you can do that. You don't have to use the SSA
Yes.
form.
Yes, but then they're holding on to your money when you could be, Victor could have it making $1 million for you. Okay? And then I just have one short slide. Who gets my money? A lot of people get confused. Who am I paying what to? What am I paying for? So let me just explain. You have your Medicare Part B. You have to pay for that. No matter which path you go, you got Medicare A and B, so you have to pay for that. And if you don't collect Social Security, you get a quarterly invoice. And if you do collect Social Security, they take it out of your check, okay? Then if you have a Medigap plan, you pay that to the carrier. You can set it up quarterly, EFT, online banking. They either pull it or you push it to them. Medicare Advantage plans, again, they send you an invoice, but if you're collecting Social Security, they take it right out of your check. Prescription plan, if you're not collecting Social Security, you pay an invoice. If you are, they take it out of your check. If you choose, those are by choice. And then you have your prescriptions that, of course, you pay at the drugstore. So that is where your money goes. Because people get confused. How many checks am I writing? Who am I writing them to? If you collect Social Security, it's pretty easy. They take your drug plan, your Medicare Part B, and your Medicare Advantage plan right out of it, and you're left with 2 cents. Your Medigap plan, you have to pay on your own. It is a third-party insurance carrier. And the thing I just recommend, set it up online. Make sure you have it automatic. Because you never know if you might get sick, you might forget, the mail gets lost. Maybe 1 month you can get away with. They'll cut you off like I don't know, a chicken head, I don't know. But they'll cut you off, and you don't want to fight to get it back. Yes?
If you're paying your prescription plan directly to your insurance company,
Yes.
then Medicare will just take out the extra supplemental cost that you have to pay, the IRMA cost on the prescription plan.
That comes out of your Social Security check. Yes. So that they know where to get the money. Okay? And that's pretty much it. Those were the questions, and those are just some resources. Okay?
Okay. So hopefully clients are getting our message, which is we are all about your personal economy and helping you achieve financial security. Okay? We do study behavioral finance. And this short presentation that we put together is about the noise of the financial media. Financial media main purpose is obviously to make money. If you watch some of these shows like a CNBC and you have Kramer on, he's creating almost like an MTV type of situation that you keep watching, where he's beeping a horn, he's doing a backup of a truck, but you can never ever rely on him to worry about your personal economy. He's just, and obviously they're selling a lot of advertising dollars on that show, but some people, believe it or not, kind of follow these people, and it's dangerous because nobody knows, they don't know their personal economy. And really, everyone out there is fighting for your attention. The attention is always going to try to get you to be under the urgency side, okay? Where the sensationalize. So you constantly, you watch these news programs, and every 10 minutes it says breaking news. Breaking news, breaking news. Unfortunately, maybe only a few of them really apply, but sometimes what's happening to people, they're becoming numb to it. So then actually when there is breaking news, they might not be paying attention. And that's definitely a concern. So they do use the sensationalism to try to keep the viewer. And obviously the financial media, and you could all through, it's coming to you every way, not just magazines, it's coming through the internet, it's coming through your phone, it's coming on your TV, and everybody's targeting your attention, and hopefully you're going to watch what they're doing. Our job is to act as a firewall between a person acting on emotion versus having a strategic plan, okay? A lot of people, and even on this, you could talk to somebody, you could watch it in the morning, and you'll have a talking head say this is going to happen. And then in the afternoon, they're saying something different. That's more for speculation, which we're not speculators. That's more for traders, which we're not traders. We are investors creating a long-term plan which is more goal-based. But it's hard to get away from it, very hard. Now let's see what we have next. Okay, why do people tune in? The initial thing is, I want to be informed. I want to be an informed person. But unfortunately, what does inform you of is, you have a lot of quotes going on. Apple did this today, bad news on that. A lot of predictions. Predictions are very, very dangerous. All these people are trying to make these predictions that the market's going to do this, and gold's going to do this, and Bitcoin's going to do this, and recession is going to do this. If they really knew, why would you tell everyone? And why would you say to everyone that this is going to happen to Apple, or this is going to happen to the market? So really, and like I mentioned before, listen to someone in the morning, listen to that same person in the afternoon, and it's a different answer, unfortunately. Okay, so, the big question, how might the financial media be a detriment to an investor? Influences in personal behavior is the problem, okay? Our job is also to manage expectations, is to manage behavior, to keep people away from big money mistakes. That's a big part of our job. So when this is being asked, how might the financial media be a detriment? If somebody gets hooked into this, and we've had clients say, hey, Susie Orman says this, another person says that. How come should I be doing that? And then our answer is, number one, it depends. And number two, how does it affect your personal economy? And at that point, I'd like to hand it over to Mr. Anthony Benante.
So we're talking about our presentation and what we're going to say and what might be useful for you guys to hear. And Victor talks about tells us he's going to talk about how the financial media has a lot of noise. So then I think about what I'm going to say, and my first slide put up is the R word, right? And I know what that means, but I look around the room when we're talking about the presentation, and Nick is like, well, do you mean retirement? I'm like, no, not retirement. And someone else is like, how about risk? Oh, that's good. I mean, but it's still not the R word I'm looking for. And Victor's like, you gonna talk about ravioli? And I'm like, maybe I should, maybe I should. But so I thought maybe this slide might help. Nick helped me find this one. Any idea here? I don't know if anyone else has, but it seemed to me in the month of August, I heard more stories about recession in the financial media than I've heard in quite some time. And I don't know if everyone would agree or not. Quick show of hands, has anybody heard about a story about recession or even thought, all right, look at this, everybody. So it's not uncommon, right? So what the heck is a recession? Well, officially a recession is defined as 2 negative quarters of growth. And that's measured by gross domestic product, which are the goods and services that are produced in the United States. So, all right. Here is the most recent readings for GDP by quarter. Second quarter is the most recent, up 2%. Previous quarter up about 3%. Technically, not in a recession, at least based on the most recent data. Now, this is lagging data. So this represents the second quarter where it'll be some time before we get third quarter data. It's usually a couple months behind. But it would take a while for us to officially be in a recession. Even if the economy tanked this quarter, you're still 6 months out from even finding out whether we're in a recession or not. So, but they're talking about it, right, in August. Well, we got lagging data, but you also have leading data. And on this chart, just, for simplicity, the blue line is basically just saying, tell us a bunch of statistics that are more current than GDP and let us know how the economy is doing. They're leading economic indicators like stock price and people's wages and other things. This is a chart that shows back to 1999 or so, and it has the previous 2 recessions in 2001 and 2008. And if you look at the chart, you can see that prior to those recessions, those leading economic indicators, that blue line, they drop off pretty hard. Where we are today is in the top right-hand corner. So GDP looks pretty good. Leading economic indicators look pretty good. So why is everybody talking about a recession? Could be because we've been in economic expansion for 10 years and somebody's thinking, hey, a recession is coming, so they're looking around for indicators. Anybody know what this is? Treasury curve. Yeah, that's exactly what it is. So this is a chart of returns that investors would earn for different time periods for U.S. government bonds. And on the left is the shortest time period, and it goes all the way out to the right. Now, what economists and market participants and other people watch is called the shape of the yield curve. And there are basically 3 different shapes. There's a steep sloping shape, a flat shape, and an inverted shape. Inverted means, and technically speaking, they focus on the 2-year treasury and the 10-year treasury. And what inverted is when the 2-year rate is above the 10-year rate, which seems pretty strange, right? If I'm going to invest in a 2-year bond, I'm actually going to earn more than if I invest in a 10-year bond. I could get into a lot of detail about why that might happen, but just for our discussion tonight, you should know that on August 27th, technically speaking, the US Treasury curve went inverted for 3 days. The anticipation up to that was pretty clear, and the media was talking about it. And this is a big reason why August had a rough month in equities and why you heard the media talking about recession. And the main reason is, for the previous 50 years, every recession has been preceded by an inverted yield curve. However, is the big thing. So I took this chart from a BlackRock presentation. BlackRock is a big financial company. We use some of their mutual funds and some of their ETFs, our iShares, and we use some of their investment choices in our, for our clients and for ourselves. And on this chart, and what they're saying is on the left side, and it's kind of hard to read and everything, they're plotting yield curve inversions. So when the 2-year rate is above the 10-year rate, and anytime that orange line is in the yellow section, there's an inverted yield curve. And they actually mark the recessions over the past 50 years. And if you had really good eyes, much better than mine, you could see that there's a lot of indications where the yield curve goes inverted, but we don't get into a recession for a longer period of time. Sometimes it's even 2 years. So the yield curve can go inverted. Recessions have happened after the yield curve does go inverted, but it's not a guarantee and it's not an immediate response. So the fact that you had the media pumping this into the system, talking about recession, people getting nervous and selling stocks in August, what they really should have been saying is there can be a lag time. And I'm not saying we're going to have a recession or not. And I mean, at some time in the future, it's going to happen. I don't know when. But what you need to know is you can actually earn some pretty good returns in investments, even when a yield curve does go inverted. And the chart on the right says, what are returns for different types of assets for the 12 months after a yield curve goes inverted? And just simply, the very first one listed is the S&P 500 averages about a 9% return. So it's not Katie bar the door and run for your lives because the yield curve goes inverted. And because that happens, I think there's a lot of other factors that may drive this, the most recent inversion, but we do have some time, we are paying attention. And really, what should you be worrying about, right? That's what it gets back to. And Victor said it in his presentation, is your personal economy. And if you've been working with us and gone through a full-blown financial plan, what you should know is, how are you situated? What's your probability for success? Meaning, take a look at all your resources and take a look at your lifestyle, and can your resources meet your lifestyle until your 90s, right? That's what we're looking for and looking to help provide advice. And then we can also run different scenarios. Hey, I spend this amount normally, but I want to see if I can spend some more. Will I still be okay? Because in the long and short of it is, it's really just about you. Like Victor said, it's about your personal economy, and that's the advice that we're looking to give to you, is to set you up in an investment strategy that is made up of your specific situation and plotted out in different market environments. So if you have gone through this process with us, what you need to know is we run 1,000 different trials about what might happen to your investments. And it's not just good markets. It's not just average markets. It includes bad markets. It includes recessions. So you should find comfort in knowing that, hey, this plan that I have should give you confidence that when we do hit recessionary periods, you are going to be okay, or at least will give you some indicators as to what you might need to do. So don't get so caught up in what the media is talking about. Understand what your specific situation is, and the knowledge about your specific financial plan should give you the confidence to maybe not get so caught up in what they're saying on TV. Now, we talk about this all the time. Barron is in the mode of constant improvement. We want to always be doing things better. We always want to be learning. It's not just, hey, we got a great thing going and no need to change. It's always looking ahead. How can we improve our services? How can we improve what we're doing for clients? And one of the recent things that we've delivered is called a client portal. It gives clients specific access to their investment information as well as their financial plan. So if you haven't signed up for this, I encourage you to look at it, because this, again, helps you stay on top of what's happening in your financial life. And it also should prompt you to keep communicating with us And we call it having a feedback loop to make sure the information in your plan is good and hopefully gives you the best success to meet your financial goals and objectives. So concentrate on your situation, not on what the media is saying, and know your specific circumstances and know whether if you need to make adjustments or, what your future financial life might look like given how you're set up. And if you haven't done it with us, we're happy to work with you. So please contact us and let us know. And also sign up for the portal. And if you're interested, sign up for electronic statements as well too, which are now available. Mary Jean did a great job about talking about an important question, which is Medicare. And I think a lot of people want to know about Social Security too. So we'll hand it over to Nick and let him cover some things that might be of interest.
Thank you, Tommy. So the financial media, we can't control, right? If there's going to be a recession, we can't control that either. But what's one of the biggest financial assets that you have that you can control is when to take Social Security, right? So what I'm going to do briefly is go through some of our clients' most frequently asked questions, kind of give a Social Security quick 101, and then keep in mind that any Social Security question you have, please lean on us because we have advanced software that we can help review this. We have Social Security experts that we can lean on to help answer your specific question. But just to give just a brief summary, how do I qualify for Social Security? Many of us know that you need to work at least 10 years. Social Security defines that as in quarters, so it's 40 credits. But few of us know that how is our Social Security actually calculated? Well, they take a look at your highest 35 years of work and they give you an average. So if you've only worked for 35 years and you collect Social Security, that's going to be your average. If now you work 36 years, the lowest earning year, maybe in your teens or your 20s, will get replaced. Hopefully, now you're in your 60s and your income's higher than it was maybe when you're in your teens and 20s, hopefully. That can replace a lower income year. So one of the questions we get is, hey, if I continue to work, is that going to affect my Social Security? It depends on what your earnings are, but we can help answer those questions. Most of us know that for Social Security you can take any time between 62 and 70, but if you take it early, there's a reduction. If you delay, there's an increase. When's my full retirement age? People born before 1955, 66. People born after 1960, it's 67. Anybody in the late 1950s, Social Security has this nice little chart for you. And it's pretty easy if you think about it. Start in 1955 and each year add 2 months. Okay, so 55, you're 66 in 2 months. 56, you're 66 in 4 months, and so on. So this is directly from our Social Security software that you all have access to through Barron. So I just wanted to give you some perspective of what taking Social Security early means and how that might change if you have a short life expectancy, a normal life expectancy, or a long life expectancy. So I aged myself a little bit and said, Nick is now 59 years old, has an estimated PIA, which is primary insurance amount, which is your full retirement amount. Social Security has a lot of vocab. A lot of it just means the same thing. So if I took my Social Security at full retirement age, I would get $2,500 a month. Now, if I took it early, I would only get $1,760 a month. That's almost a 25% reduction. Age 70, I would get $3,100 a month. Every year we delay Social Security, it's an 8% return. So let's give some perspective on this. A lot of people say, hey, I've earned Social Security, I want to take it early. Okay, well, taking it early, you get a reduction, and if you have a short life expectancy, let's say you pass away at age 75, that was the right decision. You took it early, right? But no one knows when they're going to pass away. But this helps give some perspective. Taking it early, if you lived only until age 75, you get the most cumulative benefits. versus if you waited till full retirement age or 70. There's almost a $90,000 difference there. But now let's take a look if we delay, now we live until actuarial basis of mid-80s, which we think most of us, a lot of us are going to live to. I think, and it's even going to get longer as medical technology increases. So what you'll see is now that you've hit 85, the cumulative benefits of taking it at age 62 is the least. And now you start to get into where we call it, what you've heard, might have heard of a break-even point. Break-even point, kind of what you're seeing here, between 67 and 70 for your normal life. It's almost the same. It's only $18,000 difference because the cumulative benefits that are being delayed at some point surpass what you've already been receiving if you took it early. But then let's take a look if somebody does live till 95. Now this is important when it comes to also married couples. This also think about at least one of you living to 95, not just both of you. There's a good chance at least one of you will make it to past 90. If you took it at age 62, you would have only gotten $695,000 of benefits versus $930,000 benefits. That's almost $300,000 of government benefits to you. So when you're thinking about, should I take it early, should I delay, it all depends, but lean on us and we can help kind of show you these numbers for your exact situation. Some of us have heard about spousal benefits. So remember what we said, how do I qualify for Social Security if you work 10 years? Well, if you're married and your spouse qualifies for Social Security and you don't, because maybe you didn't work or you stayed home or you didn't work the whole 10 years, or maybe you worked but it was all cash and you didn't claim anything, which we don't recommend. There's something called a spousal benefit. So your spousal benefit is equal to, can equal up to half of your other spouse's benefit. So my wife's name's Jennifer. So let's take an example of Jennifer's benefit being $3,000 a month, and my benefit only being $1,200 a month. So since we're married, how Social Security looks at this is says, I actually get an extra boost. I get $300 more because we're married, so my actual benefit is going to be $1,500. So the spousal benefit is something that we really can help you with when we're doing the calculations. Should we take it? How does that affect things? Keep in mind, we've had clients go to Social Security office requesting this and them saying, no, you don't get it. Then they come back to us and we write down exactly what you should say, and they go to a different Social Security office or a different person and they say, yes, you do get it. So it really does depend who you get at Social Security, but kind of let us give you what you can expect. So at least you go into the Social Security office with some kind of ammunition of, hey, this is what I think I should get. So whoever you're talking to kind of knows what's going on. Even if you're divorced, you can get spousal benefits. Your marriage would have had to last 10 years or longer. You have to be currently unmarried. You're age 62 or older, and your ex-spouse is entitled to Social Security benefits. So even if you're divorced, you may qualify for spousal benefits. Another question we get is, can I work and get Social Security benefits? Well, if you're hit full retirement age or older, you can work all you want. Social Security will not affect your work income will not affect your Social Security. If you're under full retirement age, Social Security has this formula, and the actual formula is they will deduct $1 from every $2 you earn above $17,000. So just an example here. On the left, we have someone who's making $100,000 a year, and their Social Security monthly benefit is supposed to be $3,000 a month. Well, if this person's 63, they're not going to, and if they file for Social Security, they're not going to get a check. Social Security is going to hold on to that until they either come below the income limit or hit full retirement age. Now, if that person's making $50,000, that $3,000 Social Security, they only get to keep $1,600 of it because of that formula. So again, if you're working and you're thinking about collecting Social Security, let us run the numbers for you first before you say, hey, I'd like to turn this on, because depending on your income, you may not actually get a check. Another important thing to know is what happens to Social Security when my spouse passes. Well, Social Security then turns to a widow's benefit. And actually, widows can qualify for benefits as early as 60, not 62. So if you're a widow, you can qualify for benefits at 60. It would be reduced, just like it would be from 62 to full retirement age, but you can qualify. Also note that for your widow's benefit, this could be a strategy where you can collect your widow's benefit and possibly delay your own benefit. So again, another strategy that we can help run for you if this is a situation that you're in or someone you know is in. Another question, how much of my Social Security is taxed? So your 100% of your Social Security isn't, you're never going to get taxed on 100% of your Social Security. They follow a table system. So if you're an individual and you make more than $34,000 a year, 85% of your Social Security will be considered taxable. If you're married, filing jointly, and you make more than $44,000 a year, 85% of your Social Security will be taxable. Now, that includes all income. So that doesn't mean if you're getting RMDs and dividends, anything that's added to your income will count towards this. So don't think that I can stop working but collect investment income and get around this. So, Nick, when should I file for Social Security? Well, I have a couple questions for you. How long are you going to live? How much older are you than your spouse? Do you have longevity in your family? Do you have children? Sometimes children can have benefits. Are you working? Have you ever been married before? A lot more questions. And the bottom line is it really depends on everybody's specific situation. Please, if you're reading an article and it says you must take Social Security at 62, just give us a call and we'll happily talk to you about that. Social Security, as you saw before, can be hundreds of thousands of dollars in benefits. So we want to make sure that we're looking at this seriously. And it's one of the things that we really can control. So to kind of finish it off, I just want to say thank you.